Hello, everybody. Welcome to today's webinar. I am Michael Cavanaugh. I am the managing member of Regiment. We are a digital investment bank and private fund family. I'm here today with Brendan Walsh. Brendan, you want to say hello?
Hello, everyone. Excited for today. Going to give a great lesson. Mike's going to give some great lessons today, and then I'm going to do some brief self-directed 5 minute or less lesson at the end here.
Great. Yep. We're really excited about our partnership with Rocket Dollar. Brendan and I go back to our days working together here in Chicago, but super excited that we had this opportunity to come in and do a little educational webinar today. So finding a private investment that aligns with your long-term investment strategy. Before I jump into it, I think it's key to point out that this is educational in nature. Nothing I say today is a method or style to encourage people to invest in the private markets or a solicitation to sell any types of securities for the private markets. It's more along the lines of just sharing with you a top-down kind of high-level look into how our company, which is one of probably thousands across the country that invest in the private market, and kind of a purview into our processes of the investment selection and how we stay involved as an observer to the private investments that we select. So kind of the layout of today's webinar, I'm gonna give you a brief background of my experience in investing. We're going to touch on what we believe are the three fundamental building blocks of investing in private markets. It's really the three fundamental building blocks are investing in anything. It could be public markets, private markets. It could be investing in yourself. I think we believe in these three core tenets is really a benchmark of how to choose where to put your money in any type of market. But today we're specifically focused on private markets. And then I'll offer up a story out of respect for everybody's time. I'll offer up a story, a real life application of how we approached an investment. So we'll just jump right in, and then right at we'll carve out 5 to 10 minutes for Brendan. He's going to give a deeper dive into the checkbook management with Rocket Dollar. So a little bit about my background. It's kind of a diverse background. You can see I'm a former recovering trader. I was a broker and a floor trader from 1997 to 2002 at the Chicago Board of Trade. I traded in the grain room. Specifically, I traded wheat, and I also traded in the 30-year bond room and pit. And it's really where I learned the relationship that people have with money and the relationship between risk and reward. Got thrown into the deep end of the pool, trading in the open outcry style of trading. And when I left the floor, I joined a couple of different financial technology startups, learned a lot about the different ways people get educated on investing. And we really focused on those startups. We focused on investor education based on what we learned in the bowels of capitalism, in the pits, where it was, dog eat dog. You learned risk management. And I'll dive into some of these as the three building blocks. You'll learn that risk management, I won't let the cat out of the bag, is very important. I went on to manage several different strategies in the equity options world from about 2006 to 2011. Managed roughly over $100 million in a few different strategies. We had some retail brokerage that we did the education for, and just about every asset class in the United States: stocks, bonds, options, commodities. We had a boutique investment financial services firm, and in 2012, I merged that firm, which was Know Your Options, into RCM, and essentially learned the different aspects of how to properly invest in different types of alternatives markets, starting with commodity markets, from commodity trading advisors to private hedge funds, and really got to learn the nuts and bolts about how the private markets work. And we recently decided in February that we were going to launch our own digital investment bank and private fund family so that we could benefit from where we started seeing a lot of money move into different non-traditional asset classes, and really wanted to be, part of the first to enter that marketplace. So we launched Regiment in February of 2020. Not giving you all this background because I want to impress everybody. I'm giving you this to show you the diverse nature of my personal background, and then to have you understand that we have a lot of people on our team that have as much experience with different diversity from different disciplines. Not only different disciplines, meaning like true PhD and hard knocks kind of street cred knowledge, but we've got people that have higher level of academic, performance, MBAs in finance. We've got people with the level 1 CFA on our team, Series 65 licenses, 7. So the diversity of our experience is more why I wanted to jump into this, to show you how we've applied these 3 fundamental building blocks and how we continue to apply them to private investing. So here are the 3 fundamental building blocks of private investing or trading investing. And like I mentioned before, it's in really any type of investment, but you need to utilize a system that relies heavily and focuses on risk management. If you're a trader, that could be a system of stops and profit targets. In private markets, your system of risk management, what you focus on still is going to involve financial modeling on how you value companies, how companies, industry research and what exits are, what the valuations of exits are. There's a whole bunch of things that you have to look at in the private markets, and you have to look at them in different verticals. But I've got a couple of examples I'll dig down into. The second step or building block is discipline. So discipline is important because you can't waver from your investment thesis. So each of our funds has an investment thesis that we create with the idea that we're not going to go out and invest in these things to make a bunch of money. We're going to thoroughly review anything that we invest in with the idea that we don't want to lose the money. And we're going to try to think of every way that we can, and collectively as a group, to combine how we've lost money on deals in the past so we don't repeat those mistakes, and having the discipline to adhere to that system from our team that makes group decisions. Each of our funds has an investor committee, so there's no decisions made by one person. So having that discipline to adhere to the thesis of every fund based on the mistakes and learnings from past investments is really the crux behind the risk management and discipline. Now, the funny part about those 2 building blocks, it's not a third here. Like a third of investing isn't risk management, a third isn't discipline. It's probably 5% risk management, 5% discipline, and then 90% is the adaptation. You have to constantly be testing your models, asking yourself questions about, are we in the right space at the right time with the right people? And it's the hardest challenge because it's very hard to learn all the different risks that exist in investing. It's kind of like when you ride a bike, you fall off and skin your knee. In the investing world, when you make a mistake or fall off your bike, so to speak, you lose money. So you want to keep the risk management tight to whenever you're investing in something you've never invested in before, or somebody on your team has never invested in before, but it fits the other parameters of your thesis, then you want to start smaller than you normally would. Just that concept of adaptation, I wanted to impress on you, because you have to constantly be doing research and open to smarter people than yourself poking holes in your thesis. Our company's lucky that I'm not overly too sharp, and we've got a lot of more smart people around me, and they ask a lot of questions. So the third building block is the one that you have to invest the most time in. Digging down a little bit more into risk management, and I won't beat the dead horse on risk management because I've got a case study I'm going to run through, but these are just some examples of risk management. If you look at the different verticals of private markets, you've got real estate, private equity, cryptocurrencies, film and entertainment, there's startups, venture capital, like the list goes on. So each one of these risk management profiles for yourselves, individual investors, as well as funds, you have to look at the nuances of what are the risks from the perspective of each one of those types of verticals of private investment. This is more geared towards like a private hedge fund that trades more traditional capital markets. But doing the risk management on a cryptocurrency investment in a startup and a cryptocurrency investment through a private hedge fund are going to be completely different risk management processes with different checklists and different questions. And the time it takes to do that due diligence is up to you. Like I said, we take the time to do the due diligence when we invest because, like I said, we've got risk management in mind because we don't want to lose money same way we've lost it in the past. We want to learn from our experience in the past. How you apply some risk management is you select your market or industry vertical. Let's say it's venture capital. Are you going to invest directly into the company as an angel investor? Are you going to join a collaborative or a syndicate with other angel investors that invest through a syndicate, like a special purpose vehicle that a venture capital fund puts together? Or do you invest directly in the venture capital fund? That's probably a 4-hour educational webinar within itself on the merits of long-term investing on your own, investing in a syndicate, or just putting the money in the fund. The due diligence process, I've got a checklist I copied that's on the next slide. I can show you some of to the extent of how we dig into the due diligence process, but there's always the risk reward scenario, right? Formulating your risk reward scenario, like the old adage in venture capital funds, is if you invest in 10 startups, you should expect to lose all your money on 8 of them. One be so-so, or you get on first base by getting hit by a pitch, and then one of them is going to be a 10x or 20x that makes the whole return for the fund or your own personal portfolio worth it. Venture is going to have a different risk to reward scenario than something that would be more actively traded, like a fund that trades a long short equity strategy. That type of investment is going to have a different reward than a real estate project. But knowing each one of those verticals and each one of those buckets where you're either directly investing on your own through a syndicate or into a fund, it's going to have a different risk reward scenario. One of those scenarios is going to include, if it's you investing as an individual and you're doing the due diligence, are you able to do all of that stuff? Do the funds give you the resources to do the due diligence? And do you have the time and expertise? That also comes into mind when you're doing making the decisions on where you want to be investing your money in the private markets. So here's just a checklist of some of the things that we would do on a private hedge fund. From one of our funds, our investor policy committee would be responsible for gathering all this info, putting it into a deal memo, and then applying to the fund to see if it's a viable investment for one of the Regiment funds. So some of this stuff is pretty, topical, but you get the contact and corporate information. It doesn't stop there with getting the contact and corporate information. You're going to want to do a background check. You're going to want to make sure that the corporate information, the tax ID number, everything that they gave you is actually what they said it was. I always say that professional investors don't ask questions because they don't know the answers. Professional investors ask the questions to make sure you're telling the truth because they fact check everything you tell them. So a lot of times people don't want to do the due diligence. Even the professional investors, that's why they form syndicates, because it's a heavy lift. It takes a lot of time to do due diligence the right way. And even if you do it the right way, it still doesn't ensure that you're going to have a successful outcome with your investment, because it's still a fairly risky investment. And it depends on obviously what sector you're in, what industry you're investing in. But this is not an exhausted checklist. This is just a high level checklist of the different things that we have to do to gather all the information and facts. And then once you have all the information and facts, you fact check. And if you pass those screens and fit into the realm of an investment thesis, it's now investable from a fund, professional private hedge fund objective. So here's a good story about how one of the deals that we looked at a few years ago, and this one is closed. It's already up and running. It's a hotel in southeastern Wisconsin. Um, the developer was having a tough time raising money because he was a first-time hotel developer, um, and he looked to us to help him raise money through our investment bank. At that time, it wasn't an investment bank. We were still doing capital raise consulting as a non-registered broker dealer. But I've had experience in raising funds, and I read through his whole PPM, and I asked him a bunch of questions about where the money goes, if investors put money in, what is their preferential treatment. I basically went through every line item in the deal, and he answered all my questions. I kind of went through the due diligence process with him, not as formal as a fund, but just to put my name on it as an individual. And a couple of the things that made this investment attractive to present to people, and again, small disclosure, at this time we didn't have the Regiment real estate fund ready to invest. This is one of the deals that inspired us to set up the funds. This particular developer has a certain method of which some is proprietary, so I'm not going to give away his trade secrets on a webinar, but he was able to de-risk the hotel investment as a first-time investor in several different ways. One is he surrounded himself with a team of hospitality professionals that had 20 plus years of experience in all the capacities of the hotel industry, from hotel operator to hotel feasibility consultant. He brought in a team um, and gave them a stake in helping stay interested and involved, skin in the game, so to speak, to help him build a series of different hotels. Because that was one of the biggest risks we addressed with him. The first question I asked him is, "Hey, this looks great. How many hotels have you built?" And he looked me right in the eye and he said, "Zero. This will be my first one, but let me show you how I am going to address de-risking that." And he surrounded himself with a great team, including a guy that had built like 20 hotels, a guy that's operated over 100 hotels for one of the largest hotel operators in the United States. So he really de-risked that by putting up a great team. Um, he made it less risky for the first, I think it was like the A shares, maybe like 25% of the equity investors that came in got to get paid dividends during construction. If anybody's ever invested in a hotel, you know that it takes about 18 to 24 months to build a hotel and another 2 years generally to stabilize it. And the developer or plan deal sponsor needs that money to get going and breaking ground and paying tractors to move dirt on day one. And you're not going to get paid for 4 years generally as an LP in a hospitality deal because of how long it takes to build and stabilize a hotel. So dividends during construction to the first 25% of investors was appealing to help de-risk the first-time hotel builder. He got some money from the actual village that now reduced what the capital stack required of the equity investors. So their equity got them more bang for their buck. So you had two wins coming in with, you know, um, the dividend during construction and the TIF funding, and then he got a 43-acre parcel, and then the village wanted this hotel bad enough that they gave him exclusive rights to resell any other parcels, and that could offset the primary debt on the hotel. So typically in pre-COVID regular times, without these de-risking instruments, money coming from the village, the dividends during construction, TIF funding, all that stuff, a hotel is an 80-20, 80% debt, primary mezzanine, and then 20% equity. Um, in this case, he was able to do the hotel and give up the same amount of equity for about a third, meaning instead of having to raise like $2 million from the LPs, he only raised $1 million. But it gave them the same equity control as if they would have put in $2 million. So this is just one example of, many deals that we've looked at. This is one that we jumped on because it intrigued us, because it had better looking terms and less risk than what a typical hotel investment would look like. My little disclaimer on that is hotel investing is deemed one of the riskiest investments in real estate. Um, so I don't want to trigger anybody to run out and start looking at hotels. The point of this is hotels are very risky. This person did a great job in de-risking what a risky investment looks like. So we touched on risk management. I gave you a little bit of a case study overview. Discipline, like I said, it comes down to having the discipline to stick to your investment thesis and your rules. That valuation and pricing, I think in the private markets, most of our team thinks that valuation and pricing is probably the number one thing that you have to stick to and look at in your investment thesis when it comes to discipline. A lot of the other stuff is fixable, but if the valuation and pricing doesn't make sense, that is the most important thing to stick to as far as your investment thesis. It may be the hardest because generally the valuation and pricing comes down to a two-way negotiation between whoever the deal sponsor is and the investor. And I always tell everybody on our team, the investor wants the money. The investor wants to give you the money tomorrow, and the deal sponsor always wants the money yesterday. And coming to a negotiation on valuation and pricing, having a solid idea and not breaking from your thesis is what I believe the most important part of maintaining your discipline. Once you've established your risk management thesis, I really truly feel that the valuation and pricing is probably the most important. What discipline also does is it helps you close the window on emotion. Emotional influence in the decision-making process in the financial markets is not good. When emotion comes in, money goes out. So we firmly believe in that decision by committee, because individuals tend to make more emotional decisions than two humans, which tend to make maybe more emotional decisions than five humans would with the thesis. Um, Hindsight's 2020, and being objective is probably the trickiest human trait as far as being in the private deal space. Um, you have to ask a lot of questions, and you have to be patient, and you have to do what's in the best interest for your investors. So remaining objective and using as much of your experience in past dealings is super important. We also have the discipline as we keep ongoing communication with each manager, issuer, hedge fund manager, developer to make sure that their strategies are adhering to our investment thesis to somewhat keep the managers honest. So when we have a deal that we're looking at, one of our rangers will be the internal spokesperson and relationship manager that stays in touch to report back to the investment committee that this investment is looking good, it's staying in line with our thesis, and if it's not, how do we get it back on the tracks? I'm just going to skip over because we're running a little on time. That was just applying some discipline to a typical hedge fund manager, but I kind of just explained it there. I kind of wanted to get into the adaptation of strategy a little bit. I mean, market conditions. I mean, we're looking at one of the biggest market condition changes in the history of market condition changes with COVID-19 lockdown. How you were doing due diligence before COVID-19 has been a very hot topic in the professional investing world. And to say how much time I personally have put in, and I know my team has put in, just talking to other fund managers on how they're adapting and adopting their principles, like principal investment theories in their thesis to make decisions on how to invest after or during these market conditions have shifted. What trends are these going to hurt? What new trends are going to develop? And how do we either mold what we believe our investment theses are and as a group change those or adapt them to make it that we don't miss the next big move or get hurt by one that had already happened. Lucky for us, our company started in February of this year and we didn't have any existing lookbacks on any investments from our funds. We have some companies that we work with um, on the investment banking side, but we don't have any. We haven't allocated any funds from any of the funds that we have set up or are in the process of setting up. So fortunately for us, we didn't have to triage any companies that we already had investment in, and we had no rearview mirror and a clean slate to look at opportunity versus triaging portfolio companies in secondary markets. Um, all of this stuff goes into adapting. I always say lifelong learning. The person who doesn't think they know everything and is open to asking objective questions to people that are willing to answer them, that's always part of it. You always have to be educating yourself. Almost 99% of the investment market, whether it's public or private, hinges on trust. Trust is built by two ingredients. The recipe of trust is proximity and frequency. How often you see somebody and how close you can get to them when you see them. You'll trust them more. So people don't just, if I met somebody for the first time today and they came up to me and said, could you walk me through that hotel investment again? If I don't really know and trust them, what benefit do I get is what I'm going to think. And they're going to be saying the same thing. Why would this person give me the secret scoop on how to do a hotel investment? It's just the nature of the beast. So educating yourself and building trust with proven track record, investors that are willing to give you their time and educate you, I think is like the hardest part of adapting, but very, very important. Um, and I know I'm real close to my time. Not a sales pitch, a quick plug. We're Regiment, regimentib.com is our website. We've got an investment platform and a family of funds. The processes I've been talking about today, we take, and apply them, write a check from one of our funds, syndicate other investors onto our investment portal. So you can visit our website. You can use a promo Rangers and you'll get a discount, a $50 discount on the Rocket Dollar process to open an account with them. The one really cool feature and what I'm most excited about in our partnership with Rocket Dollar is if you find an investment on our platform and you call us and we walk you through the diligence and you've passed the KYC and accreditation levels, there's a feature on our software that says fund this deal with your Rocket Dollar account, and there's a push button feature. But you don't get to that page until you get through the AML, the KYC, but we do have API integration with Rocket Dollar. Super excited about that. I'm going to pass it over to Brendan, and I know we're going to carve out some time at the end here, but I just really want to, again, say I really appreciate everybody's time. Again, this was meant to be educational. I just wanted to give you a look in a little bit into how a professional investor is a steward of others' money. So they have to be very, very risk management oriented, adhere discipline, and constantly adapting. So thank you again, everybody. Brendan, tell us more about Rocket Dollar.
All right. Thank you. Thank you, Mike. So some of you might know me already from the phone at Rocket Dollar. I help answer our phone here, do a lot of our business operations, and also just work with partners like Mike. So very quickly about me, came from Chicago as a financial advisor, was doing advising, in the commission world, then the fiduciary world, then in 401k education. So brought that and moved down to Austin to work with our CEO, Henry Yoshida, and our team to really try and attack the self-directed IRA market. And current Rocket Dollar customers, you'll learn something quickly on here in a few minutes. But what is a self-directed IRA? It's basically an IRA that has the ability to invest in alternatives. And we also offer a solo 401k for the self-employed. And what is so big about these types of IRAs is there's a lot of great stocks and bonds custodians. Those have been evolving since the 1970s. But what many people don't know is that investing in alternatives like real estate, like a private hedge fund, has been possible since the 70s. To invest with your 401k, and then the self-directed IRA developed as well. And we've tried to really popularize that model and make it a lot cheaper to do. It was often just thought of as a really expensive tool of the mega rich, someone like Mitt Romney, and the fees were at least sometimes $1,000, some up to $5,000. And we've hoped to really try and bring those down and make that much easier to do. So I'm just going to jump into here how Rocket Dollar works, and then how some of our competitors work, and how we're trying to bring out a product to really compete in that market as well. So the main Rocket Dollar product is the IRA LLC. Everyone is very familiar with an IRA as soon as they start getting retirement funds. You have your 401k. Most people start putting money, into a traditional or Roth IRA. So you'll see that box at the very left here. And that's very similar for Rocket Dollar accounts. We create an IRA as well. But what often happens is you can only invest with an IRA what is currently available on that broker or custodian, or what is approved. And so the New York Stock Exchange, very easy to access. Maybe accessing something like a traded REIT, like a Vanguard REIT, very easy to access. When it comes to investing into that hotel deal in Wisconsin, or a specific real estate fund that's not traded, cryptocurrency, startup investments, VC. We even have customers investing in lumber, farmland. The list goes on and on and on. Almost anything you can invest with in cash is possible in your retirement account. And the great part about this IRA LLC is that we have a LLC created out of Colorado and a bank account for every single Rocket Dollar customer. So we create a unique structure for every customer to use a bank account and go out and buy investments. So that bank account works a little bit like your money market account, in a stock account. You buy Facebook stock, you sell it, that money returns to your account so you can go out and buy new investments. And the really innovative part about this structure is that it allows you to keep all the tax benefits from these investments. So you can keep traditional IRA benefits or Roth IRA benefits, depending on if you open a self-directed IRA or Roth. And then you get to avoid capital gains as well. And you get to manage these investments through stuff like a checkbook, a bank account, and a checking account, almost like you would a little small business, or just entering a fund through a wire or an ACH payment. Think of enabling your Chase bank account to go out and buy these interesting alternative investments. Okay, so there's two types of IRAs in the self-directed IRA world. Some of our competitors, I'll just rattle them off: Millennium, Pensco, Midland in Chicago. A lot of companies with IRA trusts in their name. And we've decided to sell the checkbook control model, which has an LLC and a bank account. And just quickly review some of the pros of our product, and then how we're trying to compete in that other direct custody world. So what's great about this IRA LLC and checkbook control? It is very easy to use after it gets set up. So a lot of people are not familiar with an IRA LLC or this kind of IRA LLC bank account. But once it's finished and you get your head wrapped around the Rocket Dollar process, you basically have a checking account. You can use that to send a wire, ACHs. You can get a rent payment from a tenant back right into your bank account. You can even lend money, and then that person gets easy bank transfers coming back to you. So sometimes it's an investor that's really looking to learn and really invest in a lot of different alternative asset classes. We can guide you through that process. Our customers also like it because they get their LLC and bank account to directly go buy the asset. Rocket Dollar helps you set up this structure, but Rocket Dollar does not actually own shares of the hotel or the specific investments. We provide a way to custody your IRA LLC, but we do not go out and buy the shares for you. So a lot of customers really like this, is that Fidelity and Vanguard and these huge companies, they have great reputations, and they've built on decades and decades of confidence that when you put money into them and you put it into a stock, there's not going to be a mistake or it's suddenly going to get lost for you. When it comes to the checkbook control, even if Rocket Dollar went out of business, you still have an LLC, you have an FDIC insured bank account for your cash deposits, and you are the manager of that LLC, which provides a lot of comfort to our real estate investors, crypto investors who get to control their own keys to their crypto investments. And if any disputes, you as the LLC manager get to decide that. You don't have Rocket Dollar speaking in your ear, trying to mess with you, tell you to sell an asset, getting in your business. You get to control everything about that investment. Great part is that there is no deal review or time to wait for a custodian to approve it. So if you're a manager and you're ready to go on a hot investment, if you see a property in your town that's going to be a fantastic rental and value, you can go out and send a wire that day to that investment. You could sign paperwork. You don't have to call Rocket Dollar, call me, call our team, get paperwork signed, go through all these jumbled steps that a lot of our customers start getting really frustrated. You can, as I mentioned before, you can invest in almost anything allowed by the IRS. Kind of covered the checkbook, bank account, and stuff already. So some quick cons, sometimes it's a bit more expensive to initially set up. We've tried to make that really affordable at $360, and then $15 a month to enter this checkbook model, which is hopefully has brought the price down across the board out there in this checkbook IRA industry. And it does take a bit of active participation of the account holder to get used to the structure and just figure out how to use it. And then there is direct custody. And this is really similar to how TD Ameritrade and Fidelity work. You have an IRA and you might be clicking online, but who is actually going out and buying the money? It is TD Ameritrade is buying the stock for you for benefit of your IRA. TD Ameritrade is making sure that gets into your IRA and shown in the online system for you. So with a lot of our competitors, they will have direct custody IRAs. They'll create an IRA for you, but the custodian is still approving the money to go out to that investment. And that provides, a little bit more guidance, but also some additional hurdles that you have to go through, like the due diligence that Mike was talking about earlier. So some quick pros about this model. It's sometimes easier for a first timer, someone doing one alternative investment, just trying to quickly get into it. If the initial setup is sometimes less expensive than checkbook control models, we've been really going to try and bring this cost down in 2020 in a number of areas for people. And, if you're going for one alternative investment, again, you can just go grab it, peace of mind, you've got this investment done. And again, some quick cons of the direct custody model. If you're doing a lot of investments, syndication, multiple times a year, going out and buying 6 or 7 different asset classes, the fees can really add up. And this is a lot of the frustration with our side of the industry. It could just get explosively high as you pick on 5 or 6 investments. People are kind of kicking and screaming to get off and see if they can get into the IRA LLC. Then all investments have to be reviewed by the custodian. So, if you worked with Mike and Regiment, a real estate company, a fund, you're ready to go, you're all jazzed and you're ready to send money, you have to wait and sit there. And you also have to prove that that is a valid investment that your IRA can enter. So you could have an investment, you are totally confident, you've done all the due diligence, and then the custodian could put the brakes on that after you've already transferred your money and gotten things good to go. And so that can be really hard for, a hard to value startup, a private loan to a business, a very small business in the area, an international investment, which you could actually do with a checkbook IRA very easily, like real estate in another country, or cryptocurrency, which is, has markets every day, but it's just a new asset that some custodians don't know how much value to accrue to it. So I'm going to wrap things up here. We've gone on long enough. Just wanted to go over those 2 models. And we're going to keep doing education with Regiment here. So love for you to answer your questions. Here's just quick pricing, Rocket Dollar, quick plug. Love to answer your questions and also say we're going to keep doing this education in the future as well. So we hope that you can keep tuning in for our future efforts. Katie, so can we just check, is there, we got the question chat going and we can get anyone's questions lined up.
Yeah, absolutely. So everyone should have access to the Q&A chat. If at this time you have any questions or even comments that you'd like to share, please feel free to go ahead and put that in the public chat and we'll address those as we see them come.
All right. Q&A. All right. So I'm going to read one here. Ted Pearson. Do you think the changes in the market conditions are a good motivator for alternative investments, i.e. not the stock market or traditional investments? Mike, so you want to kick things off on that?
Yeah, I will kind of expand on, my thoughts. Again, educational. I'm just kind of giving you a look into a thesis, that was behind our decision to start investing in alternatives with Regiment, and the change in market conditions. Which market conditions? I'm going to make an assumption in this question of like the recent COVID-19 change in market conditions, but I'll even walk it back further that the stock market and bond market, traditional capital markets, have become less appealing from a risk reward perspective, in my opinion. And we really started seeing a movement of big money going into non-traditional alternatives, non-traditional markets in general, but even non-traditional alternatives in March of 2019 when the Federal Reserve paused the interest rate hikes. A lot of money started moving into real estate, hard assets. So the short answer is yes. There market conditions right now, the tailwinds of what I just described starting in March of 2019, where big money started pouring into non-traditional alts, was accelerated by COVID. There was a little bit of a headwind. When we locked down, right before our lockdown, we had an advisory board meeting with Regiment, and we were anticipating that money would tighten up for a little while. The stock market would get volatile and sell off. I had no idea it would recover this quickly, but that was kind of our early thoughts, and we're always questioning what we think is going to happen next. I'm not super bullish on the stock market or the bond market. There's a bunch of money in cash. So yes, thank you for answering the question. We see current market conditions, we see money moving into the alt space away from traditionals. And with the stock market where it is and increased volatility and bond markets not having high yields, it's not even the motivation as much as what else are you going to do with your money? putting it in stocks doesn't seem appealing, and putting it in bonds doesn't seem appealing, and you're sitting on cash, what are you going to do with it? That's kind of answering a question with a question, but yes.
And I'll give one quick commentary, and then we have another question from Patrick Sankson that came in. I'll read off. So thank you, Patrick. My quick commentary is obviously working at an alternatives company now. So, I have some bias here, but when the March 23rd drop really just shattered a lot of people, our phones went scarily dead silent. And it was really customers trying to lick their wounds in their stock portfolio. They were worried about their stocks. They're trying to make sure they can check their stock portfolios. And we had a lot of customers call us and say, we want to come to Rocket Dollar, but we need to get some recovery in my stocks before I'm comfortable selling out and losing real estate. And those people were right, because as shock to the Rocket Dollar team as well, we saw a momentous recovery. So people have been calling us about very experienced alternative investors and new investors as well, trying to figure out how they can get into defensive assets out there. So a question from Patrick Saintson. I gather Regiment prefers to be an equity partner rather than a debt position holder. Is that correct? Which one of your funds works with commercial property, such as multifamily and retail?
Yep. Great question. So to answer the first one, yes, we'd prefer to be an equity partner. We have a broker-dealer, so we have investment bankers with experience in finding debt that's priced right. So as an equity holder, we're kind of on your side that we'll help you find the primary and mezzanine debts to place. The name of that fund is looking to be Regiment Foxtrot. So I'm in the process of, I'm not a real estate subject matter expert, disclaimer. So each of our funds, we have to have like a manager or somebody on the team that has that level of experience. And then we form a board of advisors that would have investment experience either in the form of being from a family office, they're from academia and teach real estate in a graduate school format, or we have other sponsors on the advisory board. So Regiment Foxtrot is the name of the real estate fund. We would prefer equity, and then I think I answered both of your questions. And I'm happy to chat anytime, Patrick. I think in a follow-up, we'll send out our contact information.
Yeah, and we'll have this recording in the Rocket Dollar newsletter as well. So a question from Derek. Is Rocket Dollar seeing more interest in certain sectors or industries so far in 2020? Curious if customers are investing in more traditional alts like real estate or new economy opportunities like cryptocurrency. So real estate and cryptocurrency have definitely been our two top investments since COVID hit. Just a little bit about the personas of people, I think that's really informative, is the real estate investors, it's always been one of their real estate people like to stick to real estate. That's what they like to do. And a lot of people that have never done an alternatives deal before also like to dip their toe into with a real estate investment. So we're seeing more interest there, also just because of the defensive nature of it. A real estate market, of course, can have its own risk, but if you buy, if you're looking at a property and you feel, this area so well near your home or away, in a strong area, that will retain some value. When you look to the public markets, you look to these other ways, some people just can't grasp, how is this value justified? So that's why a lot of people are going to real estate. Cryptocurrency, a lot of people, it has its very strong people look to that community for education. A lot of people really just look at the Federal Reserve, they look at money supply stuff, and they also look that crypto is very forward thinking. So it was very, very Wild Westish a few years ago, but you see much more mature companies jumping into crypto and dipping their toe in it, working with it institutionally, trying to figure out ways to work with that investment. Okay. And then we have a question from Dan Jones. Do you invest in industrial warehouses or things that can be turned into the current mall decline?
I personally have not in the past, nor do I personally. Our fund will look at any type of real estate opportunity once the thesis is developed. So we're not investing yet from the real estate fund. I just want to make sure that was clear. But a couple real estate trends that would be interesting. I'd like to learn more, Dan. So I'm happy to connect offline. We do notice some big trends in real estate shifting very quickly. So yeah, no, the converting into warehouses from the malls. I mean, I'd be interested, in taking a look at a deal if you have one, and we can run it past our committee. It's just a little early for us right now with real estate, only because we have to take, it'll probably be 60, 90, maybe 120 days because we have to take the time to set up the advisory board of our fund and set up the thesis. It doesn't take that long once you get the people, but I don't want you to think that we're ready to receive a deal and fund it. But if you've got a deal, we've got an investment bank. We can have one of our bankers take a look at it, and happy to chat. Might be an offline conversation, and we'll share our contact information. Brendan, I have a question for the group, if that's okay.
Yeah, I have one quick comment on Dan's and I'll let you go.
Yeah, go ahead.
I think what we're seeing, Dan, around warehouses and this stuff is there's a lot of deals around servicing of these warehouses. Maybe not specifically a mall, but is it the solar panels on the roof of the warehouse? Is it the logistics and building around the warehouse? Is it somebody that works closely with Amazon and sells them property, et cetera? That kind of takes advantage of, Walmart and Shopify, whatever it is, this new kind of logistics economy around warehouses rather than exactly it. So that warehouses are in general an opportunity. Just I don't think either of us have too much direct commentary you can give on the mall side. Mike, you want to go ahead?
I'm just reading Dan's response. Just wondering if you have that access, which I don't. As a small guy with 4 to 5 rental properties, however, it would seem that we could get access. We've got some larger capital partnerships where we know what deals the larger capital is looking for, and it attracts the developers of larger build outs. So we do have access to bigger deals. And that's the whole reason we set our structure up the way we have it set up. One more question here, looks like from Pat Smith. Can you talk about opportunities for retail investment into hedge funds? I think, Brendan, that would probably be geared more towards you.
Yeah, and about hedge funds, so we have, investment banks and some private equity and more hedge fund type investments on our Rocket Dollar Partners page. So Regiment is one of those on there. When it comes to retail access, one thing that you never know unless you ask, and this is really important to, there might be a minimum investment level that's, 10,000, 50,000, 75, 100,000, 250,000. You never know if you ask someone, say, hey, I would love to come in at this level. Is there a way to make it work? A lot of funds have ways to give retail investors access at smaller dollar levels, and some will even do a sidecar or some type of entity where they will put 15 or 20 smaller investors together, have them enter the fund at the same time, and that entity is technically one investor. And that's a great way, if you start conversations, if you network, don't let the initial investment level, if you feel like it's close but unachievable, totally deny you from ever starting a conversation and exploring some options. If the more retail investor side.
Awesome. My question for the group, because Regiment and Rocket Dollar are committed to continuing these educational type webinars. If anybody after the webinar or wants to type in the chat right now, are there any certain or specific topics, interests in the private markets, discussion points? Like if anybody has any suggestions as to what you would like to have us educate you on, we're open to it and would love to, get some feedback on what you guys are looking at and what you guys want us to share our knowledge and insights on that would make it valuable for you to come back to more of these educational webinars. So feel free to type it in the chat or send in a follow-up email anytime.
Yeah, and so we'll wait to see if we have any more questions. We can wrap things up soon here. We're getting on about an hour. But, Rocket Dollar would never be where we were without our partners and also customers getting education. Whether that comes from us, our partners, or different places out in the alternative market space, we know that, if you don't know how to use a Rocket Dollar account or don't know what to invest in, it's sometimes hard to take the plunge or, open an account and then you're sitting there, what do I do with it? So we love to do this education and also work with people like Regiment to keep bringing these opportunities. And so Mike, I, and Katie, and the whole Regiment team will be back here again, and we hope that you tune in for it.
Absolutely. Thank you, everybody. Thanks, Brendan. Thanks, Katie. And don't forget, Rangers is the code. You get $50 knocked off of that first year fee for entering the code when you open the Rocket Dollar account.
Yeah, it's Regiment, but
Regiment. I'm sorry, Regiment. $50.
We'll make sure it's both. All right. Thank you, guys.
Yep. Thanks, Brendan.